Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 270 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. This week we are deviating from our normal schedule to welcome Ryan Dietrich back to the show. Ryan joined us for the first time in June of 2023, so a little more than a year ago, on episode 204, in case you missed that and wanted to go back and listen to that. Ryan is the chief market strategist at Carson. In his role, he is responsible for advancing Carson's investment research team, delivering market insights, and expanding the firm's investment platform. Prior to Carson, Ryan spent 6 years at LPL, most recently serving as their chief market strategist. And at LPL, he was responsible for managing more than $70 billion in assets, along with research and writing for advisors. He also holds the CMT designation. So Ryan, thanks again for joining us for round two.
Well, thank you for having me back. That's good. There's plenty to talk about, but I guess it's exciting because I'm sitting in Cincinnati. I know you guys are right up the road, so OH to everybody. I like it.
Right. Yeah. And I guess before we get started, I know that you're a Bengals fan. Are you going to the game on Monday night where they play my Washington Commanders?
Well, I guess it's safe to say my son will never listen to this. My son's birthday is the 19th, so Thursday, and he doesn't know this yet, but yes, we are going to the game because one of his presents is going. Now, I believe that's a present that maybe it's a little bit for dad, maybe it's a little bit for his brother also. But yes, we are going to go to the game because Gus will never listen to this. I don't think he knows what I do all day, which is fine. So he's 12. So that's a pretty good present for a 12-year-old. Take him to a Monday night game. I know Washington's 1-1. Obviously, Bengals are 0-2 because they always start 0-2. So good luck. Bengals are going to be fired up. But we'll see. Hopefully a good game. And honestly, hope the Bengals win. You start 0-3. We talk markets. We talk numbers. You don't make the playoffs. And they know that. So they need a W.
Right, for sure. Well, yeah, I will be in attendance as well. It'll be my first Bengals game. So I was waiting for Washington to eventually come to Cincinnati, and we got it this year. So maybe I'll see you around with the other. I don't know how many people that stadium holds. 60,000 people that are going to be there as well.
We're in the north end zone. I'll tell you that much. So if you're in the north end zone, that's where we are.
All right. Yeah. All right. Well, before we get to our discussion with Ryan, we'll quickly review the month-to-date and year-to-date performance of the major indices that we track. This data is from Y Charts and as of the market close on September 17th. S&P 500 down 0.2% for the month and up 18.1% for the year. The Dow Jones Industrial Average up 0.1% for the month and up 10.4% for the year. Nasdaq Composite Index down 0.5% for the month and up 17.4% for the year. The Russell 2000 Small Cap Index down 0.3% for the month and up 9.3% for the year. And the Vanguard All World Ex United States ETF down 1% for the month and up 8.8% for the year. 3-month Treasury rate at 4.95%, the 2-year Treasury rate at 3.59%, and the 10-year Treasury rate at 3.65%. So I guess just dovetailing right off of the rate conversation, Ryan, I think the elephant in the room this week is the Fed and the highly anticipated rate cut today here in a little less than 40 minutes. And I guess just looking at the data, what's your outlook for stocks over the next 12 months after the first Fed rate cut today? And, do you also think that the election year seasonal weakness hit a little early this year, or do you think there's more volatility to come before the election?
Yeah, a lot to unpack there. So let's just start with the rate cut, right? So 25, 50 basis points. We'll see. We know the Fed's obviously going to probably have a dovish tilt to it. It's widely assumed we're going to probably get 100 basis points of cuts this year and probably a little bit more next year. So I took a look at the idea of when you're near an all-time high in a rate cut, because usually when the Fed's cutting, it's like a 100-year pandemic. It's like a crisis of some sort. So markets and usually stock market's not doing all that well. But I found 20 times since 1980 when the Fed cut within 2% of an all-time high. So pretty darn close to an all-time high, 20 times. It happened most recently in 2019. I think people kind of forget that. We were like making all-time highs in 2019. Fed was cutting. Things were doing okay. 1 year later, ready for this? I don't know if we have a drum roll sound or not. Drum roll, please. Market was higher 20 times. S&P 500 up 20 times, all 20 for 20. Okay, 1 year after they're cutting when the markets are near all-time highs. Hey, this time could be different. I came on with you last year. I guess we said it was June, I think, of last year. We were overweight equities. We were one of the few shops coming into 23. We were saying no recession. We thought stocks do pretty well. Well, that happened obviously in 23. Are we still overweight equities? Yes, we are. We've done some tinkering. We've taken out some of the EM exposure we have. We've added some some low volatility names, low volatility ETFs, I should say. Again, overweight equities, but we're aging in this cycle. It's like a 2-year-old bull market. So overall, we're still overweight. We still think that the Fed is cutting. Inflation is last year's problem. We're not worried about inflation. We've been saying that for a while now. The Fed's finally realizing that. The employment backdrop is slowing. It's not screeching into a recession, but it is slowing. So we think a couple cuts make sense. Now, to get to your question, though, listen, the last 2 weeks of September usually is kind of volatile. October of an election year is the worst month on average in an election year. So the next 6-7 weeks, whatever it is till the election, to say it's just going to be smooth sailing, we'd say probably not. Okay, we don't think so. We think we might have some of that seasonal weakness coming. We might have a little bit of a slip on the banana peel, so to speak. Oh, do we see a 15%? No, we don't. One of those violent 5 to 8%ers sometime before the election. We think it makes sense, but the underlying pinnings, and we're going to talk a lot more about this, underlying pinnings which got us here are still solid. Economy is still solid. We're still in a bull market, in our opinion. I think I answered all your questions there, but that's kind of how we see things playing out seasonally and then even longer term. A year from now, we get to do this. I wouldn't be shocked at all if stocks are up another, 12 to 15%. Nice and solid. Still like we're in a bull market here.
Right. And then just to hit on the recession piece there, I think there's been a lot of data being thrown around over the past couple of weeks with the Fed anticipated cut today, is that, if we don't go into a recession, stocks tend to do well. But if we do go into a recession over the next 12 months, then stocks tend to act poorly. So you guys are still in the camp that no recession on the horizon as of now?
We are. Exactly. We are. Clearly, if we do go into a recession, a lot of the way we're positioned right now wouldn't work out, right? But we're paid to manage money, and that's how we see things. Now, are we slowing? Yes. The consumer, are there some cracks out there? Yes, there are some cracks. Just look at yesterday's retail sales number. Came in again better than expected. Bankruptcies actually are kind of improving overall. Yes, if you look at credit card delinquencies and things, they're going higher, specifically credit card delinquencies. But then you look at it, and the honest truth is, where's it coming from? It's coming from some of the low income earners. To be honest, everybody, some of the people that don't always move the economy. People that are wealthy that still move this economy are still in pretty darn good shape. Now, two things that do worry us a little bit here, it has to do with higher yields. We don't think the Fed's fund rate should be up over 5% right now with inflation coming back like it is. But you look at small businesses, right? There are more people employed by small businesses in the United States than anything else. Okay. Small businesses are the lifeblood of our country. We know that. They're not really investing in themselves because higher rates usually aren't good for them to go out to a bank, get a loan, do those things. It's harder. Let's put it that way. That's why small caps, I think we're going to talk about small caps. That's why small caps have done so well, lately and thinking and sniffing out these rate cuts. So that could help also. And then the housing data. The housing data, it is what it is. It's been very, very weak. We know people aren't necessarily refinancing yet. We're seeing some of those refinance. I think a lot of mortgage people are telling, hey, wait a couple months. Wait 3 months. Refinance then, because we're going to have even lower long-term mortgage rates by then, and that makes sense. So you're going to unlock a lot as it pertains to the housing market with consumers, which can be another positive. Because honestly, hopefully, I'm sure people listen to this podcast. Right? You've got really smart listeners and obviously really, really great clients that listen to this. If you've owned some stocks the last 5-10 years, you've owned a house or two the last 5-10 years on paper, and I know it's on paper, but on paper, just about anyone listening to this is probably worth about as much as they've ever been worth in their lifetime. Okay, and that's not just to say everything's great, but I'm just pointing out that the balance sheets of consumers in the United States are in some of the best shape they've ever been. Last comment on this, I work with a real smart guy named Sonu Varghese. I know you guys follow him. He does a lot of cool stuff. He looks at like all the debt and equity and liabilities that are out there on balance sheets. Okay, keep this real simple. We nominalized it by disposable income because there's more debt right now. That's what the media tell you. Oh my God, credit card debt, $1 trillion. Yes, it is a lot of debt out there. They don't tell say about that equity part because people are worth a lot more. So maybe you have a little bit more debt, but you have more equity. All right. That's kind of the consumer balance sheet. When someone looks at it, the consumers are in the best shape they've been in 25 years, going back 25 years with the data. I don't think most people realize that when they turn on TV because all you hear are the negatives. And believe me, there are a lot of negative things out there, but the consumer is still in pretty darn good shape. We're calling this a mid-cycle slowdown. We do not see a recession. We think with these rate cuts coming, that can help juice investment and help the housing market, which should keep this economic cycle of growth going.
Ryan, love the perspective. I'm in agreement with everything you said. I want to dig down a little bit deeper about small caps. I know the Russell 2000 index is pretty much flat since the beginning of 2022, and I got that data from Y Charts Mark just a couple days ago. Yeah. What's your research tell us about small cap performance once the Fed starts cutting rates? I know you talked a lot about on your post about the rate sensitivity of small caps. Your thoughts, Ryan?
Yeah. Small caps, again, it feels like a dirty word because somebody's like, oh, small. It's like the Red Sox and Yankees, small caps, large caps. We own a little bit of all of them, right? But yes, we have been slightly overweight small caps and a decent amount overweight mid caps in the portfolios and models we run for our Carson partners. At the same time, specifically about small caps, kind of like I talked about, higher rates don't always help them. And it's like Lucy in the football with Charlie Brown. We've seen these big jumps in small caps, honestly, last year and a half or so. Like last year, right? The Russell 2 small caps were up, I think it was 24 or 25%, somewhere around there, close enough for government work. The last 2 months last year, right? An enormous spike, and then it kind of came back down, still up about 10% for the year, like we talked about, like you mentioned in the stats at the start of the year, or start of the show here. But the bottom line is you see drastic alpha, aka outperformance, of small caps relative to about every other group once the Fed officially starts cutting. We looked at the last 5 cycles, keep this fairly simple. You see significant outperformance on small caps 6 and 12 months later after the Fed officially starts a new cutting regime, and obviously that cutting is starting now. We see more cutting, and couple other things real quickly on small caps. If you look at like valuations, right? We've been more neutral technology. It's like people thought we were crazy for saying that 3-4 months ago because we see valuations are high. We see positives out there, but it's a high part of the market. You have anything disappointing, and earnings. Some of the big tech names a little disappointing on earnings. Techs come back to life or back to earth, I should say. But relative, large caps relative to small caps. Small caps are the cheapest they've been since the late 90s. Okay, I don't think a lot of people realize that. So that is a cheap part of the market. You don't buy things just because they're cheap. We've been in this industry a long time. I've done it for a couple decades. For the longest time, or for the whole time, I'm like, EM's good because it's cheap. EM's good because it's cheap. EM's underperformed for a long time, and it is cheap. Sometimes it's cheap for a reason, but small caps are cheap. And next year's earnings on the S&P 500, I know this is expectations. It can change. Right now, expectations about 14% year-over-year earnings growth next year for the S&P 500. Small caps are up almost 20% growth next year. And we think, again, if this economy avoids a recession, things in the U.S. continue to improve overall, we think that small cap growth could be a little understated. So you're going to get better earnings growth and are cheaper. Those are reasons we like small caps, let's call it the next 6 to 12 months here, along with the Fed finally cutting rates.
Makes sense.
Yeah, and in addition to the Fed cutting rates, I think it's been widely known that the yield curve has normalized in the past few weeks, right? So, the last 3 times this happened, stocks obviously struggled for a period of time, but there were instances in, I think it was 1980 or the late 1970s where yield curve inverted and then normalized and stocks did just fine.
Yeah.
Do you think the yield curve indicator will follow through with stock weakness now for a 4th straight time? And I think I know your answer, but the yield curve is something that we've talked about a lot with listeners. So I think a lot of people are aware of it. And I've followed Campbell Harvey's work for a number of years now. I'm sure you're familiar with him.
Yep.
And he's like, hey guys, we got to be diligent about looking out for what's next, just because of this inversion that is now ended.
Yeah, the uninverted, I guess, is what we call it. For 2 years, we heard the inverted yield curve would be the end of the world, and now we're being told by the same people, no, it's actually the uninversion that's worrisome. Let's just remember, in 2019, the yield curve did invert briefly ahead of a 100-year pandemic. Yes, the yield curve predicted that recession, I guess we could say, but we'd be skeptical, if we didn't have a 100-year pandemic, maybe we don't have a recession. And I'm not minimizing the yield curve or inversions or uninversions, but we've heard a lot of these things, right? Leading economic indicators. We've had the SOM rule, obviously the inverted yield curve. What's the other ones? ISM manufacturing, sub 45. All these things they told us for all of 23 and a lot of 22. When this happens, it's always a recession. It's it's always a bear market. A lot of these indicators have not triggered what they were quote unquote supposed to do, right? So is a yield curve lumped in there? Maybe, maybe it is. So overall, to me, of course I follow yield curves, but I think what's a little more important and easier to follow for listeners too is kind of what are the credit markets doing, right? What are credit spreads doing? Investment grade corporate spreads, AAA spreads, triple B spreads. Keep it simple. You can get the free data on anyway. You mentioned Y charts. Go to Y charts. Type it in. We are not seeing major weakness or major concern out of the credit markets yet. So yeah, the yield curve inversion, it's there. I say if there's the monster under the bed, the credit markets are going to sniff it out way before. I mean, junk bonds, like at the time we're doing this, are hitting 2-year highs. All right. If junk bonds are hitting 2-year highs, to me, that's the market's way of saying, listen, we might have a little slowdown or something, but it's not a calamity that's coming, because you'd be really worried if you're going to get paid back on that money you loan to a risky company. It is what it is. Junk bonds wouldn't be doing what they're doing with the strength they've been showing, in my opinion, in our opinion, if the economy was truly going straight into a recession. So we'll chalk it up for we're skeptical that it's going to trigger a massive recession right now. We've got other indicators we follow that we're just simply not seeing major signs that a recession is imminent.
I'm in agreement with that, and I know Mark is as well. Next, let's kind of pivot, Ryan. Your insights are awesome for our listeners.
Thank you.
Let's discuss, November 5th, election day coming up in regard to the markets. Lots of political rhetoric, normal during that 4th year of the presidential election cycle. You've had many posts year to date reminding investors to stay focused on their long-term goals, not get caught up in every headline or campaign promise that's made. For those that might not follow your research as closely as we do, please share with our listeners and viewers just your thoughts firsthand when I say those things.
Yeah, first off, I was born and raised in a little town called Springfield, Ohio. So I'm not going to make this political, but let's just say, I'm hearing, my goodness gracious, a lot going on. So it is a political year. It is politics. It is what it is. Coming into this year, what did we know, right? What did we know? Well, we had a president up for re-election, and I get it. That's kind of changed a little bit, obviously, with President Biden not running again. But the last 10 times a president was up for re-election, the stock market was higher. It's those lame duck years where things get in trouble. 2000, 2008, yeah, different things are going on. Tech bubble implosion. What's the other? Great financial crisis. I don't know who was in the White House really slowed those down. But I think it's important to remember that. Yes, listeners, technically, I got one for everybody, so don't get too mad if you hear this and don't like the answer. Technically, stock market's done a little bit better when you've had a Democratic president, but also had more Democratic presidents going back 75 years, so the returns are a little bit better. But if the Republicans have both chambers of Congress, returns are drastically better than if Democrats have both chambers of Congress. The reality is when you have a split Congress, that's what I think matters a lot more. Because yes, the president matters. Don't get me wrong about November 5th. But if you're an investor and you wake up and we have a split Congress, the last 13 years, or maybe it's 12 years, this will be the 13th year, we've had a split Congress, stocks were higher. All right. I don't know. Maybe it's coincidence or not, but it's those checks and balances, not too much power one way or the other. I think that's what people really need to kind of be, quote unquote, rooting for. Of course, you vote for, you want to win. But when it comes to, the House and the Senate, and let's be honest, I think the latest is Republicans have a 4-seat majority in the House, smallest in 140 years, and the Senate's 51-49 Democrats, right? So there's good chance, this is above my pay grade, a lot of smart people I follow say that's going to flip-flop, okay? But you're still probably going to have a divided Congress. So that's what people should be thinking about. Now, a couple more comments on this. I mentioned October is not all that great in an election year, historically, for stocks. Yeah, think about the last couple elections, 2016, 2020. We did have some indigestion. We had some scary headlines. We had some market weakness ahead of those elections. Then we soared, okay? Once the uncertainty of the election was out of the way, and I think the reason I had a big rally 4 years ago was because people thought I'd have a big blue wave. Blue, yes, president won, but the makeup of Congress, it was a lot more divided. I think the market liked that. We think that's still going to be the play coming in November and December. And as bad as October is an election year, November is by far the strongest month in an election year. So seasonality, it's not like you just blindly invest in it, believe me, but we pay attention to it, and it's been right more often than not, honestly. So some weakness here next 6 to 8 weeks, perfectly normal, but probably a solid end of year rally. And honestly, last thing on this, so we gained S&P's of 25% last year. We're not all that far away from up 20% again, okay? And we think there's a above average chance we're going to have back-to-back 20% gains. So it'll be the first time we've seen something like that since the late 90s. It's just some stuff to think about for investors. One last thing. A lot of people didn't like President Obama. Stocks did amazing. A lot of people didn't like President Trump. Stocks did really, really well. A lot of people didn't like President Biden. First 2 years, yeah, not so great. But boy, oh boy, if stocks come back in a big way under President Biden. So just remember to separate your political beliefs from your investments. Is something that I say, I think, daily for the most part. And it's hard. Yeah, you get worked up about politics and things. I mean, we understand that. But I know you do great. You guys do great work on the show and with your, obviously with your clients, trying to separate your political beliefs from your investments. And it's hard to do, but it's really, really important, because if you sold because you didn't like so-and-so in the White House, or you bought, or well, mainly sold. If you sold, you didn't like so-and-so in the White House, the last several presidents, you missed out on a lot of good gains. And I know a lot of people that did it, talk to them all the time. I think it's really important to remind people how the economy is doing, what the Fed is up to, what inflation's doing. Those things, honest to goodness, listeners, matter more than who's in the White House for your investments. It's important to remember that.
Yeah, for sure.
Ryan's put on a clinic here. I love it.
Yeah, and I know I'm ready for this election season to be over, because I think I can recite every single political ad that I see pop up on my TV screen every night. And I was actually home for lunch earlier this week, and someone knocked on my door, and they were doing a survey, and she came right out and asked me, she was like, "Who are you voting for?" And I was like, huh, that's a little forward, but yeah, I'm ready for this period of the year to be over.
Well, who are you voting for?
Yeah, right. I remember when I was a little kid, I remember that used to be like a sacred thing, right? Like it was very private, and you would never ask about anyone.
Sure.
My parents never even told me who they were voting for. So it's interesting to see how that has kind of now switched, given the times, I guess is the best way to say it, that we're in right now.
Yes, well said.
Kind of flipping gears just a little bit here, Ryan, what's your take on bonds going forward? We've explained to listeners on the show before, the inverse relationship that bonds have with interest rates. So is it really as simple this time as bonds are a pretty good buy at these levels, with the Fed anticipated to continue to cut interest rates? I mean, I think it's widely known as well that bonds have been crushed over the past several years, obviously with rising rates. So is this just the opposite, and are bonds set to rally for a couple of years?
Yeah, keep it simple. We think so, right? I mean, probably when I was on with you last time, if we talked about bonds, I would have said we are, this is the last time again, last summer, middle of 23, we were very drastically underweight bonds. A lot of people have patted our back, so to speak, on the Carson team for some of our big macro calls and our stock market calls. We've actually probably done better in our bond calls. Nobody really ever cares about bonds, it feels like, unless you're an investor in them. But for the most part, like you said, 2022, the Barclays Ag was down, I forget, like 12 or 13%. That's your average bond fund. That was like the worst year for bonds since George Washington was the president. I don't know how they have that data, but that's what I saw from Ned Davis, and I liked it. But it's true, right? Because what usually happens, well, stocks, listen, here's a little spoiler alert. I know you guys have told so many people this. Stocks don't always go up, okay? You're going to have some down years here and there. The last 5 times stocks lost 20% or more for the year. When I say stocks, I mean the S&P 500. Bonds were up double digits like every single time, all right? 22 was such a terrible year for well-diversified portfolios because, again, stocks and bonds are both down 10%. What just happened when we had that quick 8% sell-off early August there on the worries over the yen inversion, or not yen inversion, the yen carry trade? I'm confusing my big worries here by calling it yen inversion. Nonetheless, the Barclays Ag was up 5%. All right, so you got something out of bonds. So that, first of all, we like to see that, because I hate to say, what's 4 most dangerous words? This time is different. Sir John Templeton. Well, this was like one of the first times in 2 years where the stock market got its kicked, but bonds did pretty good. That is what we want to see. The Carson team, again, we were underweight bonds for a long time. We added some long-term treasuries at this point, maybe almost 3 months ago, because the work Sonu did to listen, inflation is better than they're telling us. We didn't buy. This time 3 months ago, we heard people saying there might be hikes. I mean, honestly, people forget how quick this stuff changes. We weren't. People are out there saying there could be hikes coming this year. We looked at the inflation data and said, no, that's not true at all. We don't need interest rates here with inflation coming back and supply chains getting better and some positive things. So we actually added, and people hated bonds, honestly. People hated bonds. I mean, the Barclays Ag, I believe, is up 4% for the year right now. It wasn't that long ago. It was down 4% for the year, okay? Which, again, it had a big rally in the fourth quarter last year. But for the most part, bonds haven't done very well. Like you said, generational highs in inflation, the most aggressive Fed we've seen in 40 years, something like that. But now with the Fed easing and cutting, we're more even weight bonds here. We still have more stocks, like in a 60-40 portfolio. We're like 65% or so equities, maybe 35% bonds. We got some cash, some gold, some different things. So yeah, but overall, we have added a little bit of bonds. We've added, getting geeky, but I know listeners understand this stuff, duration, right? Some treasuries. If you own short-term bonds, when the interest rates go up, they don't go down as much. Flip side, when interest rates go down, those shorter term bonds don't do quite as well. So we've added some longer duration in the models that we run. And again, we think, the path is lower for inflation, and likely now we have a Fed cutting. So it makes sense. And congrats to the bond people out there, because you've had a really, really rough go of it. But we think, next year or so can do well. And one final thing, people think, well, if you're getting a little more warmer and fuzzier on bonds, and we have, does that mean you have to have a recession? Does that mean you have to have trouble? The short answer is no. Most years stocks and bonds go higher. All right, that's just usually how it works. But those really bad years with stocks is when bonds have done really earned their keep, so to speak. So I think for those with diversified portfolios out there, it's just nice to know that maybe we're back in that world where stocks are going to pull back. There's going to be volatility, but people flock to bonds, and that's what you want to see to kind of help you sleep at night. In last comment, 2008 stocks lost 40%, bonds gained like 15-20%. I'm not saying it made up for it. I'm just saying, hey, you're glad you had some bonds back then to help you sleep. And let's not say 2008's happening again. I don't think so. That's the extreme example. I get it. But still, that's why I think people like to have bonds in their portfolios to help them sleep at night a little bit.
Great context. Ryan, before we sign off, I know the spotlight is often on the major indices, right? High-profile sectors such as technology. Are there investment themes or sectors you believe the market's currently overlooking that could present some significant opportunities in the next few years when you have a longer-term view?
Sure. So yeah, great question there. We're overweight industrials. We're overweight financials. Now, you turn on CNBC, you're probably going to hear some other guests talk about those things. I'm not saying it's like some wildly under the radar, but I don't think most people realize how well financials have done lately. Financials, the group in general, has been really strong this year. We still keep talking about tech and all these things, but to us, if you have an economy that's not going into recession, if you have just more of a mid-cycle slowdown with more growth coming over the next 12 to 18 months, like we think it can be, to us, being overweight financials and industrials, kind of those cyclicals, are where you want to be. We're overweight three areas, okay? Financials, industrials, and then communication services. There is such thing as career risk, if you will, when it comes to not having enough technology, but we're not so warm and fuzzy over, like XLK, like technology in general. Communication services makes a little more sense to us to be overweight that area. But big picture, we do like, those industrials and financials in general to kind of continue to lead. And when you see Warren Buffett's company, Berkshire Hathaway hitting like all-time highs, it's technically a financial company. Let's be very clear. We all understand It does a lot more than that. It's really a technology company and industrial company, okay? It's hitting all-time highs. When your big components are doing that, that's to me something you want to see. Last thing on this, regional banks, right? We know the regional bank crisis in 23 just did a number on them, but they're really coming back. Regional banks had a huge rally a couple months ago. They're a large part of of small caps in general. So that's another one of those barometers out there. Regional banks are hanging in there and outperforming like they are. That's probably another sign that the big monster under the bed they keep telling us about is not really real this time.
Great insights. Great insights, Ryan.
Yeah, and I think just before we close out here, Ryan, I think it's also important to note, we've talked about today, how stocks are usually pretty strong 12 months following a rate cut, right? But I think it's important for listeners to understand that that's not a straight up line, right? So it would be easy if we're 12 months from now looking back and say, oh, stocks are up 15%. Right. But I think what's important to point out is that there will be volatility over the next 12 months. And I think the data that I was looking at, that the average drawdown during the 12 months following a rate cut, the first rate cut, is somewhere between 12 and 15%, right? Which isn't nothing. So I just wanted to point that out and see if you had anything to add, that we should expect, a correction or a sell-off at some point over the next 12 months, even if stocks are strong for the most part.
So interesting between 12 and 15, because if you look since 1980, the average peak to trough correction out of all those years, lots of stuff has happened since 1980, is 14.1%. So when I present, I talk to people, I say, go into the year thinking, you know what? There's probably going to be a 14% peak to trough correction at some point during this year. if you think of it like that, you say that kind of happens. Most years have at least a 10% correction, right? Think about last year. As great as last year was, I always talk about, stocks up 25% last year. Remember how scared everybody was in late October because we had that 10% correction, all the fear all over the place. Black Monday was trending on Twitter at the end of October when you went into that last weekend. Funny thing happened. Stocks bottomed and ripped and rallied higher the rest of the year. So just know that you're going to hear fearful things. Social media is a wonderful thing. Obviously, doing things like this is really cool to get our voices out there, for you guys to get your voice out there, leveraging social media. I do it obviously every day. But there's a flip side to it. There's so much fear and so many people just trying to sell something to you. Just be careful who you follow. You know, I mean, I like to follow some of the same people that have been bearish for 2 years. Honestly, not because I like to troll them, because I like to know what they're saying. Are they turning bearish? Are they still bearish? Are they turning bullish? Like, use them as an indicator. It's free data, right? I mean, I like to know that stuff. So just kind of remember who you're following, but also just remember again, since let's see, May 26th, 1896, when the Dow started trading, we've had wars, we've had pandemics, we've had 100-year pandemics, multiple wars, assassinations, all the stuff, all the bad stuff. The other thing is a lot of good things have happened also. The other thing that's happened, the Dow is literally hit an all-time high after all that stuff, right? We just hit an all-time high this week on the Dow, right? Since 1896, back at the highest it's ever been. So it's not like every year is going to be up. Are we still bullish at the bigger picture? Yes, we are. The next 5 years, we still think there's a big period coming. We didn't get into this. I'll keep it real simple. Productivity in our country, one of the things really no one's talking about. This isn't really investing, but it's more of a theme. Productivity in our country has surged the last 5 quarters, okay? Keep this as simple, annualized about 3%. What in the world does that mean? Well, we were like 2.1% for a couple decades before that. We finally are seeing higher productivity. Why? It's not because of AI. AI is coming. We know that. That's not in the data yet. It's because we have look at the jobs data, okay? People are in their jobs. They're not really leaving. They're not really getting fired, okay? Look at layoffs. Layoffs aren't really spiking at all right now. So you've got people in jobs, an aging labor force. You get higher productivity when that's the case. In the mid-90s, we had higher productivity, kind of like we have right now. Remember the mid-90s? We had an economy that was wobbling, started to improve, then the Fed started to cut. The worry, even with Greenspan back in 95, was if I start to cut, could inflation come back and rear its ugly head? Greenspan said, no, I don't expect that to happen because we have higher productivity. When you have higher productivity, it helps put a cap on inflation and can allow for higher wages. That's kind of a perfect area, but for those long-term investors listening to this podcast, remember, the mid to late 90s was a wonderful time for investors and a big reason because we had strong productivity for an extended period of time. Fast forward to right now, we have strong productivity. Everybody's worried if the Fed cuts, will inflation come back? We've been pounding the table for like a year now that no, because we're having better productivity that we think will stay in our country, stay for the next several quarters, maybe the next year or two, and higher productivity is that magic elixir, if you will, that again will put a cap on inflation, allow for higher wages, and keep this economic cycle going, and likely keep this bull market going probably for a little bit longer than people think. Don't forget, this bull market is 2 years old. Next month, this bull market is 2 years old. Your average bull market, I know it's average, no such thing as average, but the average one, look at the last 10, is about 5 years, okay?
Sure.
Doesn't mean it can't end tomorrow, but let's just be fully aware these bull markets can last longer than you think, and with strong productivity, we think this bull market's got a little bit left, good deal left in the tank, as they say.
And ending on optimism, I love it. So thanks, Ryan. Really appreciate you taking time out of your day today. I know it's a busy day with the Fed here in about 9 minutes. So, really appreciate you and your thoughts, and look forward to hopefully having you back on sometime in the future.
Real quickly, I'll just say thank you for having me. I know you guys quote and cite me all the time. I see it. I appreciate it. It means a lot. I'm just glad you had me back, and maybe next time you have me back, we can talk about how the Bengals, beat the butts of the I almost called them Redskins. I'm supposed to say it. Sorry.
Yeah, I know.
Sorry, not supposed to say that. Don't cancel me, everybody. I'm sorry. But be Washington here coming up. But nonetheless, hopefully have fun on Monday too. But thank you for having me, guys. I'm big fans, and just keep doing your thing. I love seeing it. And I'm back when you need me. Leave it there.
Feelings mutual, my friend.
Mm-hmm. Thank you.
All right, everybody. Thanks for listening to episode 270 of the Independent Advisors Podcast. We'll be back with you next week.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.